Welcome to Mortgage Markets and More. Welcome to Monday. My name is Peter D'Angelo from Rate. I hope you're doing well. For those that listen to the show, you're probably wondering, why is this episode happening on a Monday? Well, I was mentioning at previous episodes, I think that I'm toying around with the idea of changing the cadence of this show. So we're going to start producing these episodes and releasing them on Mondays. And the thought behind that is to provide you with a full week of information, of updates, so that you can set up your week for success ahead. And I still may do some quick Friday updates. So if you're a real estate professional taking out clients and families, you'll have the latest and greatest as far as what interest rates are looking like, any real estate news, any pertinent mortgage news. And if you are a would-be home buyer, you'll have a quick update before the weekend. But for now, it's going to be helpful so that I can provide you with all the information. And it was really inspired by this past week. This past week, we had the Fed had their meeting, and they made their announcement on their policy for interest rates. And we also had the National Association of Realtors existing home sales data. So there was a lot, and I didn't want to just provide some of that information. I thought it'd be best to deliver all of it all together, because we'll see how these things play with each other. And then also, as we kind of take a moment to think about what's going to be down the road as we go into the new year, it'll be good for us to have all this information. Next week's episode is going to be a bit longer. It's going to be a bit of a year in review and probably delve in a little bit more, but I'm going to share a lot today about my perspectives on where I think things are going to develop as far as real estate's concerned, mortgages, interest rates, which is the hot topic these days, so that we could talk about how to plan best for 2025 if homeownership is your goal and if you're a professional in this industry. Without further ado, let's get into our regular updates on mortgage surveys. Again, these mortgage rates that I'm about to share are the average mortgage rates reported on Mortgage News Daily survey of the whole country. So, kicking things off, the 30-year fixed rate mortgage is averaging 7.04%. That's up quite a bit from 6.8% Friday, not last week, but the week before. 15-year fixed rate mortgage is averaging 6.43%. That is also up from 6.05%. The 30-year jumbo mortgage is averaging 7.28%. The 30-year FHA mortgage is averaging 6.42%, and the 7/6 SOFR adjustable rate mortgage is averaging 6.98%. So across the board, we've seen rates go up. The only one that didn't move as much as the others was our jumbo. Those loans operate a little bit differently. They're not as market dependent as, let's say, your conventional 30-year or FHA mortgages. As you might expect, let's take a look at the bond market. The 10-year bond treasury yield is at 4.55%. That's up from 4.314% the last time I reported it out. The 5-year treasury yield is at 4.4%, and the 2-year treasury yield is at 4.325%. What we have right now is actually a flattened yield curve, which is a good sign. So an inverted yield curve is when you have a 2-year treasury yield, which is a shorter term bond, and that yield is higher than a 5-year treasury bond, which is a longer investment. You know, the conventional wisdom is, well, if you're going to invest in something longer term, your yield should be higher because you're invested in that asset for longer. Well, that had been inverted for quite a while, for years actually. So we've had a couple moments where it's flattened out. Right now, it has flattened out. With the bond market rising the way that it did, we're going to get into why that's happened and why these interest rates have gone up in the way that they have. So there's a number of important economic indicators that are kind of giving us a good understanding of what's going on with the economy, and that has an influence on the Fed and their decision making, which we're going to get into, as well as how the market trades, what people think, what the perspective is on interest rates, speculation on that, and these all inform one another. So first things first, we have retail sales that came in stronger at 0.7% growth. The expectation was 0.5%, and the previous reading on retail sales was growth of 0.5%. Housing starts. We had 1.2 million homes built. This is homes being started, and that's below expectations of 1.34 million. and the previous reading was 1.31 million. So we're seeing that there's not as much being built and not at the pace. Obviously, in certain markets, the demand is incredible. So this little bit of a slowdown is meaningful, even though it's a small margin comparatively. The Fed fund rate. So the Federal Reserve met this past week, and they made their announcement on their fiscal policy, monetary policy. They did cut their benchmark interest rate 0.25%, a quarter of a percent. So now the Fed fund rate sits between 4.25 and 4.5%. Remember, the Fed fund rate is within a range, but they always go marked by that completely discounted rate, the lowest one of that range, which is right now 4.25%. Why did they cut? Well, the market was expecting it. And now this is where I'm going to share some of my personal opinions. This is in no way a reflection of guaranteed rate or rate. This is my own personal and somewhat professional opinion after, spending quite a few years watching what the Fed does, what they say intently, and watch the markets to kind of understand how these two powers kind of battle it out, because you got the market that has their expectation and their own narrative when they look at the data, and then you have the Fed who looks at the data and makes their decisions. There was an expectation of a cut. We are late in December. So they delivered this cut. We're seeing inflation is rearing its ugly head. We didn't get into the PCE, the personal consumption expenditure, which did come out last week. Another reason why I delayed the production of this episode, so I could give you all of this information. And that came in hotter. I'll give you the numbers shortly. But we also had the consumer price index that came in hotter. So inflation's getting a little bit hotter from the most recent readings. Labor market's remaining pretty consistent based on the data that we're receiving. So the Fed delivered this rate cut, and now that reflects 100 basis points, otherwise 1% lower than it was before their first cut. So if we recall, they did make their first cut in September, and it was 0.5%. Then there have been 2 quarter-point cuts since then, which brings their Fed fund rate down to 4.25. After each one of these cuts, mortgage rates went up. It sounds counterintuitive, but when we've talked at length now at this point that the market is heavily in speculation, and that's what creates the lending environment, we now know categorically it's not a matter of whether they cut or not. It's around the language they use about future cuts that actually creates the market environment that we're seeing and experiencing. So the market was expecting the cut. They delivered the cut. However, the language around afterward, and when Fed Chair Jerome Powell answered questions at his press conference, they dubbed this type of language hawkish. They were saying that there's not as many cuts ahead in 2025 as was previously expected and communicated based on their speculation at previous meetings. So now with the expectation being lowered of cuts happening in 2025, interest rates go up, because the whole reason why we saw lower interest rates, if we go back, let's just look back since January of 2024. December of 2023, we got the coolest inflation reading that we had in a while, and it showed significant progress on inflation cooling. So there was a ton of optimism that started these narratives and people talking about, oh, the Fed's going to cut their interest rate. There's going to be 5 cuts, 7 cuts, 8 cuts in 2024, getting the interest rate lower, and then we're going to have lower interest rates. And then merely within 60 days of that, January, we saw the lowest rates that we pretty much saw all year, and that was close to 6%. Some of the families I was helping, I was quoting them interest rates below 6%, so something with a 5 handle on it, which is incredible. And then within 60 days of that, inflation readings came in hotter. We had all of the retail sales coming in from the holiday spending, and inflation went up a bit. That kind of cooled things off. Then we also saw some weakness happening in the labor market. So now that kind of does this push and pull. Now the Fed had their, kind of their back against the wall in some respect, because now they have their dual mandate. They need to keep the economy stable, but also keep Americans employed. And when we started seeing cracks in the labor component of our economy, that's when they had to start having discussions about making a move, which kind of brought us up till August. So if we're looking back, Interest rates went down just purely on expectations. There was no Fed rate cut that happened. Let me say that again. There was no Fed rate cut that happened in December or January of 2023 into 2024, but that's the lowest rate environment we saw. Now we've had 3 rate cuts totaling 0.5%, and interest rates have now gone up to the tune of about 0.5% from where they were prior to the rate cuts, sometimes even more than that in certain scenarios. So the actual cutting of the interest rate isn't having the effect that most people expect because the expectation continues to be about what's going to happen in the future. I could say it as simply as that. So now let's actually go into some more of the data, and it will show some of the reasoning why the Fed cut their rate, but now they're staying firm and that they're going to remain data dependent. They're going to wait and see what happens with inflation and with the job market as we go into 2025. The initial jobless claims, which we check out every week, that came in at 220,000, below the expectation of 230,000 and also lower than the prior week's number, which was 242,000. So the labor market's still doing rather well compared to where the expectations were. GDP, gross domestic product, this is one of the number one indicators of how the U.S. economy is doing. Well, our GDP growth was at 3.1%. That was much higher, quite a bit higher than the expectation, which was 2.9%. And the previous reading was running at 2.8%. So GDP is doing well. It's a sign of a strong economy. Existing home sales were at 4.15 million, a seasonally adjusted number, and that was above the expectation of 4.1 million. So there's still movement happening in the real estate market. We're going to get into that full report shortly. Personal income. There was a growth of 0.3% for personal income growth. That was below the 0.4% expectation and also lower than the prior reading, which was 0.7% growth. Personal spending increased 0.4%, so we're out of whack, right? If you only are making 0.3% more, but now you're spending 0.4% more, there's a little bit more debt that's then created to fill that gap. And that was below the expectation of 0.5%, but also up from the previous reading of 0.3%. PCE, the personal consumption expenditure. We had this inflation reading on Thursday and Friday last week. Here's what that came in at. Month over month, 0.1%. So prices went up month over month, 0.1% based on this indicator. That is lower than the expectation of 0.2% and also lower than the previous reading for October, which was 0.2%. The year-over-year growth is running at 2.4%. That's up from 2.3% and slightly below the 2.5% that was expected. And the core personal consumption expenditure, this is removing volatile elements like food and energy, that came in at 0.1% month over month. That's down from 0.2% expected and previously 0.3% the prior month, and 2.8% year over year is the core. All of this is showing us that the battle against inflation is a battle that's going to continue. And as we go into 2025, here are some important things to note. Number one, there's a lot of tariff talk. So, of the new administration coming in, there's discussion about tariffs. There's competing conversations happening, but there's a likelihood that if tariffs are implemented, that the increased cost component gets passed on to the consumer. If the consumer receives that on their end, well, inflation's going to go up because the prices are going to be going up. So tariffs being the number one thing, and this was brought up quite a bit at the Fed Open Market Committee press conference. There was quite a few questions surrounding this, which makes sense. If we see inflation's already nosing up a little bit now, and we don't have any of these tariffs implemented, what happens when these tariffs get implemented? Does inflation start to creep back up? Does it put the Fed actually making a rate hike on the table again to combat the inflationary elements? Or are they just going to keep their benchmark interest rate where it is right now and let it ride and see what happens? Because they also are going to be keeping an eye on the labor market. Now I'm going to just share, before we get into the existing home sales data, now I'm going to just kind of wax poetic on my ideas here for 2025. I'll flesh this out more next week. But the highlight reel right now in the initial reaction of what happened after the Federal Open Market Committee and the Fed's announcement of their monetary policy, The way that I see it is 2025 is going to be much like 2024. And unfortunately, we're not going to have much of a relief from the volatility that we experienced this past year. It's going to continue being a game where they can keep an eye on inflation, keep an eye on the labor market, and try to keep things as stable as possible as we proceed through the year. Market fundamentals wise, because everyone asks, when are we going to have lower rates again? My answer to that right now, based on what I see, is it would be inappropriate to have an expectation for lower rates for the next couple years. There's part of it that's my genuine opinion on it, and then part of it which is a practical approach where I believe that there's a functional utility to that perspective, particularly if you're a real estate professional and if you are a would-be home buyer. Here's the reason why. Number one, if you expect to have lower interest rates and you're hinging everything on that, and that doesn't happen, you're not going to be buying a home. And if you're a professional and you're trying to wait for the rates to come down to talk to certain clients, reach out to certain people, that's not going to happen. The good news there is that there are ways to manage this rate environment and manage it in a prudent fashion. Last week, we talked about the benefit of discount points. Right now, if this perspective holds true that I have, well, permanent discount points make a lot of sense because you can lower your cost of financing. That's just one way. Secondly, this is where the utility comes in. If you budget yourself based upon what is a higher interest rate environment than we were hoping for or expecting, you have a very realistic picture painted for yourself. You're going to shop for a home more appropriate for your budget. You're going to know when and when you cannot be competitive in these markets. So these are all things to take into account and consider. Thirdly, people were waiting for the moment to sell or look to get ready to buy, waiting for lower interest rates. What does lower interest rates look like? Well, my third point is this. Lower interest rates may not be as low as many people hope. I think that we're in an environment right now where the Federal Reserve mentioned at their press conference that they are close to what they would call a terminal rate. So they're going to reach a point. The idea is when inflation is managed accordingly and the labor market is stable, the Federal Reserve will reach a point for their Fed fund rate, for their discount rate, where they say, okay, this is where we are going to, this is our policy rate. We're going to keep it here. So right now we're at 4.25%. Let's just say it's 3.5%. They say that's a fair amount to be set as far as our benchmark lending interest rate, and that keeps inflation under control, that helps the economy, all the good things. What does that translate to in the mortgage rate market? I mean, we could look back at history, but history is not really showing us much that's really meaningful right now because we live in this time that is so unprecedented, particularly due to the shortage of inventory in some markets for housing because of the golden handcuffs that the low rate environment of nearly 15 years created. So maybe a terminal interest rate for mortgage rates is somewhere in the high fives. If we look back at 2019, before the pandemic happened, we started seeing mortgage rates were on their way up. We also had an inverted yield curve in the bond market for a time. So we had some flashes of things going on. And it's funny, not a lot of people talk about this, but before the pandemic, we actually had the opposite problem of inflation. We had a deflationary environment where inflation was running below 2%. So there was, which is equally bad, right? Because now the money isn't growing in value as time goes on. So taking all this into consideration, mortgage rates were averaging somewhere in the low fives, sometimes even mid 5% range in 2019. So I'm going to say this without any economic data, just thinking more practically and saying, well, before the pandemic, if we reach a point where we manage all of the things that happened from 2020 until now and things even out, it stands to reason it would make sense that mortgage rates settling in somewhere in the high fives, low sixes, high fives, that range may be it. We may not see any further improvement. The one caveat to this that I'm going to share that nobody hopes for, I don't hope for it, nobody does. The one caveat is something outside of the scope of these financial markets and the things that we look at on a weekly basis as I report out on this show. And what I mean by that is something happening geopolitically in the world, an escalation of conflict somewhere in the world. If the U.S. gets involved in some type of military exercise, or if there's some kind of incident that happens on the world stage, that's something that can throw a monkey wrench in because we don't have any account for that. But historically, when that happens, there is a tangible effect on the markets. And sometimes, more often than not, something like that is an impetus for lower interest rates while there needs to be a stimulation to the economy while something else is happening in the world. So that's the only scenario that I see where somehow in the short term, we see lower interest rates. Otherwise, all those projections we went over a couple of weeks ago are somewhere in the mid sixes, most optimistically landing 6.3% by the end of 2025. So this rate environment's what we've got. Take from it what you will. What the important part to remember is if you are interested in purchasing, get pre-approved, understand the numbers, understand your budget, and then see what happens. This is an opportunity market is the way that I like to say. You either got to give it your all, 100%, be all in, and work hard. It requires hard work. Work hard, and then you could do it. Otherwise, get yourself prepared financially. Go through the pre-approval process. Give me a call. It does not cost you any money, and we have a soft check on credit. So there's no negative impact to you to go through the exercise. It takes about a couple minutes to do the application, provide some documentation. Then you know that A, you're prepared, and B, you know the score. You know when you see that home that's $550,000, you already know what that monthly payment looks like, and you know it fits within your budget. So that's it. I want to wrap up all the information there about my perspectives about next year. I'll go in depth a little bit more next episode. But now let's get into the National Association of Realtors existing home sales data. There's going to be a data dump. I'm just going to provide you all of the numbers. Then we're going to talk about it just for a little bit before we wrap up today. So as I reported out just before, 4.15 million units sold seasonally adjusted, and that's up 4.8% month over month and 6.1% year over year. So there's been more activity happening nationally for home sales compared to last month and the year before. Now, the regional breakdown. The Northeast was the weakest, actually, of the regions. So the Northeast saw 510 units sold. That's up 8.5% month over month, up 6.3% year over year, with a median sales price. And again, median is the most commonly occurring number in the data set, not the average. And that was at $475,500. That's up 9.9% year over year. Midwest saw 1 million units sold seasonally adjusted, 5.3% up month over month, 5.3% up year over year. That median sales price was $302,000, reflecting property appreciation of 7.3% year over year. The Southwest saw 1.87 million units sold. They were the top dog this month. 5.6% up month over month, 3.3% up year over year, with a median sales price of $361,300, up 2.8% year over year. The West saw 770 units sold, unchanged month over month, up 14.9% year over year. The median price was $628,200, reflecting 4% year over year property value appreciation. Median sales prices we just went over, but the national median price is $406,100, and that's up 4.7% year over year. Looking at the breakout of condos, single family, and co-ops, single family sales was 3.76 million seasonally adjusted. That's up 5% month over month, and that's up 7.4% year over year. The condo co-op sales came in at 390,000 units sold. That's up 2.6% month over month, and that's down 4.9% year over year. The median prices for single-family homes across the country was $410,900. That's up 4.8% year over year. Condos and co-ops median price is $359,800. That's also up 2.8% year over year. The inventory levels. This is the really important thing to look at because we're kind of smack dab in the middle of winter now. Total inventory is at 1.33 million units listed. That's down 2.9% month over month, but also up 17.7% year over year. So if we're looking at how much is available right now, last month was an outlier. It was actually a really strong month for October. November, still pretty strong, even though month over month, that's a little misleading because October was a really strong month for the amount of inventory that was available, considering the fall, school starts again. Not many people list homes, and that's what normally October is where people start to trail off and they start getting their eye on the ball for the holidays. But 17.7% up year over year. We're making improvement across the country. As you could tell from the regional breakdown, though, now we're starting to see some separation. Certain areas are more difficult than others, and certain areas have a lot more available than others. I'm in the Northeast here, so for those in the Northeast, it's tough. Inventory is still very low. There's not a lot of quality inventory. So even though we have some inventory, the amount of quality inventory, it hits the market, and then it's sold. It's quick. We're seeing some longer timelines for listing timelines, but overall, it's still very quick. We're not talking about homes being listed for sale for more than just a couple weeks that are desirable. Then they go. The month supply, we have 3.8 months supply, which is down from the 4.2 months supply that was in October, but up from 3.5 months in November of 2023. So slight progress happening there. But as long as we're trending in the right direction, that's probably the most important part right now. But again, I highlight regions are different. We're seeing more of a disparity now. So inventory declined slightly month over month, but still remains strong year over year. Regional sales growth saw the Northeast saw the strongest month over month growth of 8.5%, followed by the Midwest and the South, and the West remains steady. Single family home sales, though, increasing 7.4% year over year, shows that there's still incredibly strong demand, and that's the economics that are out of whack. So now as we're into the winter, I just like to say this is still a great time to buy. So if you are interested, once you get through the holidays this week, maybe take some time between the holidays to check out some properties. This is where you're going to have motivation on both sides of the ball. So you're going to have buyers who are out there shopping right now. You got your eye on the prize. You are in it to win it. And the sellers, if they're listing their home in the winter, there's some reason why they need to sell now. So they have an impetus to sell, and that desire and that possible necessity to sell could be something that provides advantage to prospective home buyers. So we're seeing better trending now, which is great, but we do have some more work to do. There still needs to be some more inventory because the demand doesn't stop increasing, but the inventory is remaining kind of stagnant, even though we're making some meaningful but small and smaller than the demand requires progress. Even though that's happening, it's good to keep in mind that, we need more inventory to serve the amount of demand that continues to grow. So it's not even a matter of who's ready to buy now. For every person who has an active mortgage application, there are people from months ago who have just completely given up and threw in the towel that are still technically part of the demand component of the supply and demand economics for buying a home. So these are all things that are worth your consideration. That is it for me today. I hope you found this helpful and useful. I know this was jam-packed, this episode. We got another one coming next week. But if you have anything you'd like me to dive into deeply, feel free to reach out. My email address is peter.d'angelo@rate.com. I hope you all have a wonderful holiday season. I'll catch up with you just before the end of the new year, but wishing you and your families all the very best, and have a wonderful time with your family during the holidays ahead this week. Thank you so much for listening, and take good care.